So finish the planning handout. We'll see if we get through this. We definitely should get through it. I think I said that last week, so you guys probably don't believe me. All right, so I think we're down to page 5 or something close to it. Okay.
Yes, right there.
Okay, so this is the kind of the audit plan that we're going to look at. Audit plans, I call audit program or whatever you want to call it, but they stop that. Yeah, so we'll go through this. Okay, the audit plan should include a detailed, high-level description of the nature, timing, and extent of. So, what everything in the plan is actually, it should be a very thorough description. Is it always? Not always, but sometimes you have to refine them. And by the way, these are in some ways, these are kind of living documents. When you first start auditing the audit plan, you'll stick to it. And if you're worried about starting auditing, like, gee, I don't know if I know everything I'm supposed to know about auditing cash or whatever it is, there is an audit program. They do it. And most places will already have one available. You usually don't have to make one from scratch. But the audit program, and a lot of times they'll have, if it's a repeat audit, they'll have last year's work papers, which are very good because you can look at the new audit program and then go, okay, let's see what they did last year and go back and look at those previous work papers. So it isn't that you're on your own, you have to come up with all the things off the top of your head or anything like that. It's not like that at all. And basically, the way an audit program is laid out, if you follow the program, you will find the things that are bad, that need to be corrected, or you'll know whether these things are, they don't need to be corrected. You get evidence that there is no material misstatement. So you follow the audit program, and usually if you follow the audit program the way it's supposed to, you will find these things. So you don't necessarily find stuff because you're this genius auditor. You find stuff because you stick to the program, you do all the testing that you're supposed to and all that kind of stuff. So you don't have to remember all these things. Now, these programs are very detailed. They're not general. They're very detailed. They tell people how to do things. If there is a place that they are lacking sometimes, that I've found anyways, places that worked, is that they don't always tell why. They'll tell what the audit step is, but not why you're doing it, which oftentimes is really important. People kind of miss sometimes, well, why are we doing this? You just get so used to doing the steps that it doesn't occur to you to think why we're actually doing this test. But anyway, and a lot of times these are kind of living documents. As you get more into auditing, you will find ways to improve them, improve it, I should say, as you get better at it, at what you're looking at. Okay, so there's a high level. They talk about the nature, the timing, and the extent of. Okay, risk assessment. You look where the risks are. And the question is, what could go wrong? I know there's already a question mark there. I'm going to add another one. What could go wrong? And you do a lot of this when you're in auditing. And we'll talk about this in a few minutes here, but it talks about the likelihood it's going to happen and the amount. You know, what are the odds it'll happen? What are the odds, or what's the amount of it if it does happen? So once you find these risks, you make your audit procedures to match up with those risks. And oftentimes, the audit procedures, you'll find new risks, and you'll also maybe find things that the risks are lower. For instance, if they put in a new inventory tracking system, that's a new risk. Because, a lot of times the new systems, even as well as they test them, there is a potential that goes wrong. When I was doing internal audit, I know I told you this before, I was put on inventory I think I just started out in inventory and then I became the inventory guy. And we got a a phone call from the director. We got to go up to Canada. Why do we got to go to Canada? Because there's a warehouse there that has. They took a physical inventory, and there is an extra, I forget what it was, $5 million in inventory. I can't remember what the numbers were, but let's say it was 23 million in inventory. You take the physical inventory, and there's 28 million, which is not used the way what happens with inventory. Inventory doesn't, people. It's like people bringing stuff into work or something and giving it to the. It just doesn't. If anything, inventory is lower. You get theft, but also you get breakage. You get things that get thrown in the garbage, whatever. So it was weird that it increased, and by a lot. And does anyone have any idea why there's more inventory than they had on the books? There was one thing in inventory that they did that really wasn't worked out. How would you have more inventory? How would you have more inventory in the place than you actually have on your books? I'll give you a hint. The inventory had already been sold at one point.
Somebody returned it and didn't issue a credit memo?
Someone returned it. We issued the credit to them. We never put the inventory back on the books.
No item receipt?
So no customers complained, because if they sent back 10 or whatever, we gave them credit. But the inventory, when we received it back, even though it was still in the boxes, still saleable and all that, it was shelved. It was put back, in stock, but it was never put on the books. The only thing that really failed was it never was put on the books. Now, someone could have been taking that inventory, we would have known because it was on the books anyways. I didn't really get the feeling that's what happened. But anyway, it was a brand new system. It was supposed to, improve tracking and all this other stuff. And whatever failed, and actually we did kind of figure out what it was. It was actually the way they were taking it back in, that no one actually had the, of all the screens that came out, the people that returned it and people gave credit for it and all that kind of stuff. There was like one step that was missed, because there's inventory that comes in that you can't resell. There's inventory that comes in that you can. And that part of it was not very well worked out. Who did that? Who made those decisions? And so you'd have people putting stuff back into inventory, or determining that it was defective and sending it back to the supplier or whatever, but nothing was done on the books. So you actually have people doing their job. It just was the books weren't keeping up with it. But anyway, new accounting systems mean there's more risks. So whenever there's a new accounting system, you say, okay, the stuff we had last year was based on the old accounting system. So going into the new year, we're probably going to have to do some more testing because, again, this new system. And, there might be things that are wrong with it. Excuse me. Okay, so you do the risk assessment, and then you'll figure out what the audit procedures are. And those audit procedures, you will test the risks, see what could go wrong. Okay, how do we test those things that we need to test? And then there's other ones that we'll talk a little bit about later on to comply with the audit standards. We talked about a little bit about this. One of the things is the management letter, which really isn't a test, but it's something that you have to get from management to comply. Okay. So, a tentative audit plan is developed and based on the initial risk assessments. Okay, so we'll go through here and kind of do the plan has which type of characteristics. Okay, the audit plan is which of the following? Is it general in nature? we'll put this one with number B. We'll put this one. Is it general or is it detailed?
Detailed.
Detailed. All right. So it is not general in nature. It's very specific. It's detailed. And again, if you follow it, you know, generally anything you find, you know, if as long as the tests are done correctly and all that, you'll find. Can be changed once the audit is started.
No.
Actually, yes. Sometimes you start doing an audit and you'll find things that are out of whack. So it is, you can change things once you get started, and you'll go around with this sometimes. So, you know, it isn't uncommon to start looking at something and then you find a completely different thing. Sometimes it's stuff you never even thought of, you know, can happen. D is based on risk assessments.
Yes.
Yep. Yep. All is based on risk. What are the risks? How do we test for it? And if there's not a risk in a certain area, you don't test for it. It is the same for all clients.
No.
No.
You guys will hear this in my other classes too. My favorite fortune cookie. There is no such thing as an ordinary cat. In other words, all cats are different. So, you know, there is no such thing as an ordinary client. Target is a big retailer, and so is Walmart, but they're very different. They have different clientele, they have different purchasing, they have different everything. You know, there aren't any two companies that are the same. They're not going to have the same. Maybe changed for revised risk assessments.
Yes.
Yeah. Yeah, if you discover there's a risk that you know that you have to look into, then you'll revise your plan. Or sometimes maybe there isn't a risk. Maybe you're testing some division that isn't even there anymore or something. You know, you change your risk division. Okay. Assess audit risk. This is a really big one on the CPA exam, talking about the audit risk and how you determine what to look for. And the one thing you must get is an understanding of the client and its business environment. Let's try a different color. How about green? Inquiries, just talking to people. To be a good auditor, generally you need to be a good listener, and you just ask them. Sometimes you just let them go. So if you get people that are, you know, talking about different things and how they do stuff and all that kind of thing, you just let them go and keep up as much as you can. Write down what you can. Observation. I'm skipping. Oh yeah, I should tell you. I'm skipping analytical procedures because we're going to do that down below. Let me make sure I'm not lying to you. Yeah, I'm not lying to you. So we'll look at this down below. But observations, watching people do stuff. Relating to activities, operations, documents, reporting, blah, blah, blah. I think I've told you guys this before, but maybe I didn't. So when I first started doing auditing, and I would get the audit program, and one of the audit program things was always look at the accounting manual and see what the procedures are for whatever you're looking at. So if it was inventory, you look at inventory. If it was accounts receivable, you looked at accounts receivable. The manual that they would have for internal controls and accounting procedures or whatever for that, whatever area you were in. I quickly realized, I shouldn't say quickly, it took me a while actually, sadly, that nobody ever looked at those things. No one ever running the place ever looked at those things. And sometimes when you talk to them about it, they look at you like, what is that? I've never even seen one. I worked here for 23 years. I've never even seen that manual. It wasn't uncommon that these procedures had nothing to do with it. And if you think about it, especially companies when they start getting more efficient, how much does IBM make on their accounting procedure manuals? They don't make anything on it. They're not as important as you'd think. Every company, they should have these, they should be up to date, they should be nice and crisp, and everybody should look at them repeatedly. And quite honestly, it just doesn't happen. I found out that the best way to figure out what's actually going on in the place, which is what you're auditing, is to watch people and to talk to them, and you go out and see what they're actually doing. And I can't, and even more than the inquiry is asking people. Observation is more persuasive because you're actually observing what they're doing with their. It's not somebody telling you. It's not coming secondhand. And I can't tell you how many times someone has said, "Well, it's done this way. We do this, this, and this," and then you go watch it. They're not doing anything like that. And you go back to them. Oh, really? Oh, I thought that's how they did it. You get these. Kind of misleading, funny things, and you're documenting all of it along the way. By the time I kind of figured out what auditing was, I knew that I just would go out and see what they're doing, talk to them, just be human around them, and a lot of times they'll just tell you what they do and how they do it. Well, what do you do if it comes back like this? What do you do? Oh, if it comes back like that, then they do this. You can get an awful lot by observing and talking to them, but talking to them while they're doing it. Not talking to like a manager that, how does your payroll clerks, how do they do this? Just go and see it. So observation is actually a great tool, and it's an art. And this is observation is probably the most persuasive. I spelled that right, but in other words, those things that you view for yourself. What am I doing? I'm in the wrong. Well, first I spelled it. It's spelled persuasive. Is it P-E-R? Maybe that's it. That must be it. Okay, I'm in the wrong spot anyways here though. Apologies. Okay, here we go. Observation, what you observe for yourself, what you actually see people doing is more persuasive than what somebody tells you. So even though you ask management about it, and sometimes you will, observation is actually it's better evidence. It's more persuasive. They can tell you anything, but what they're actually doing, you will actually see when you observe it. Okay. Other procedures, such as inquiries outside the company. Legal counsel, a big one for US companies. And reviewing information from external sources. Analysts, banks, rating organizations. So for instance, like a lot of these are for larger companies. For instance, IBM, they'll have a bunch of analysts working on their company, see what those analysts say, see what the banks say. Rating organizations for bonds and things like that, see what they say. So external sources are simply those people out in the press mostly that are, how are they, the press and banks and things like that, how they are actually looking at the client. Okay. So analytical procedures. All right, first, any questions on those? So you gotta get an understanding of their business. And the idea is that you won't know what to audit unless you do get an understanding of their business. Okay, I gotta change this for a second here. Analyze analytical procedures. Analyze relationships. These are usually referred to as plausible relationships. Between data. It could be financial or non-financial. My spacing is off. I guess it's not. A lot of times these are ratios. Oh, here they got plausible relationships. Who's teaching this class anyway? Okay, analytical procedures. I am going to put something in here. I'm going to add something to all this. Analytical procedures. Analytical procedures are used to indicate where material misstatements may exist. Analytical procedures are generally not direct evidence of fraud. I should say material misstatements. Okay. So they tell you where to look. They're not in and of themselves usually an indicator of a material misstatement. So analytical procedures, they say where the problems might be, and that alerts you to where to look. But they themselves are generally not evidence of anything going wrong. And you'll see that when we go through let's go ahead and go through the little example here. So here's our example. We have our sales. So sales look like they went up by, I don't know, a couple million. And we have our advertising expense. What is unusual about the information? Just looking at just these two accounts. What's unusual? What's unusual about the way I'm looking at my computer? No, what's unusual about those? When it comes to advertising, how do you sell more stuff? Usually. Anyone? Hey, you guys are sleeping, aren't you?
I mean, there could be a logic for the advertisement spent in 2021, the sales to started in 2022. That's why I just not sure if there's a relationship between those two.
Yeah. No, you're there. This is not proof. First of all, let's say what it's not. This is not proof of fraud or about material misstatement, because these could be absolutely correct numbers. However, usually when sales go up, advertising expense goes up too. It could be you're paying more commissions, you're putting out more advertising to get more sales or something like that. So usually a plausible relationship would be that, okay, if sales go up, then advertising should go up. That would be a relationship that you would think would happen. So what's unusual? That sales increased. Decreased. Now, this is not evidence that there's been anything wrong going on. It does not mean that there is absolute, but it does mean, okay, this is unusual. This is not what we expected. A plausible relationship would be that the sales go up, these go up. You look at companies that have big sales, they have big advertising. With small sales have smaller, there's some kind of relationship between sales and advertising. So when you run into this, it goes opposite, it means you gotta look at something. So what could be the problem? Well, it could be that sales are overstated, that maybe these sales are not really 22 million because you expect that this went up. Or it could be that advertising expense is understated. So let me do it now. So sales may be overstated. And advertising let's see, understated. Now, it could be that both of those are fine. Whatever it is, they sold more stuff and so it could be sales overstated or advertising understated. Those are kind of the risks we would be looking at. And again, it just tells us where to look. Okay, let's look at the sales. Let's look at the advertising. Looking at those more closely. And again, it might come out that, hey, whatever, they decrease their advertising and they increase sales. That's the way it happened. But it could also be that one of these is misstated. So again, analytical procedures are not evidence of themselves, but they just tell you where to look. Analytical procedures are actually required. They are required. Let me write that in. In every audit, they are required. They're required at the beginning and the end of the audit. So they're actually required twice. They are so important as something like, depending on what you read, 95 to 99% of all material misstatements are found through analytical procedures. They are so effective at finding them. They're not proof in of themselves usually. There is a weird case where they can be. But generally speaking, though, they just tell you where to look. So you're required to do it at the beginning of the audit. You're required to do analytical procedures at the beginning of the audit. And then, so you do the analytical procedures. They tell you where to look. Where's, where the funny looking things going on. You go check and see if they're okay. And during an audit, a lot of times you'll give corrections to be made by management, you know, and if they make them, you can change the financial statements and all that. Sometimes, you know, you get to the end and there's still nothing. But anyway, at the end, you're required to do them again, especially if you made suggestions for corrections to the financial statements that management has done. You want to do the analytical procedures again because those statements have changed. There might be other things that come out now that the parts you talked about were corrected. You analytical procedures again at the end to see if there's anything that jumps out as, gee, now we have to look at this because you know, you're looking for those plausible relationships. So they're required at the beginning and at the end. And the reason they're required is that they are so effective at finding material misstatements. They are not evidence themselves. You got to go look for more, you know, you got to go get the evidence on it, but they're very good at finding where to look. Most of your larger CPA firms, they have this, a lot of the stuff is done automatically. They'll give you a sheet that'll print out what areas are odd, you know, where the financial statements, where the things that you might want to look at. And for the things like the financial statement ratios and all that kind of stuff, that's usually done already. When you go do an audit, they'll actually run that report. They were doing this back when I was doing it 20 whatever years ago. So I'm sure they even have it more sophisticated now. But okay. Another thing is risk analysis. Whenever you talk about risks, you're talking about the dollar amounts. Let's pull that. And the probability. So dollar amounts and probability. And so you multiply them out. All right, just underline the whole thing. Okay, so this first one, $5 million times 1% is what? 50,000, I think. You may want to check that just to make sure. 400,000 times 40% is 160. And 5,000 times 80% is what, 4,000? Did I do this right? Yeah. Okay, so this is sort of like, this is the expected ways of saying it. Which one of these risks would be the greatest concern for the auditors?
Risk B.
Yep. Risk B is the one that is the greatest risk for a couple of reasons. First of all, you know, the expected amount here, which is can be a little bit misleading because, you know, we're saying that the dollar amounts, these are the upper level of the dollar amounts. So if they are off, they could be up by up to this amount. But, you know, the probability that it's, you know, off would be like 100, on average, it'd be like 160,000. But notice that this $5 million loss, it's very rare that it's going to happen. The probability is very low. You know, once in 100 years, right? Now, 40% is much higher. This has a pretty good chance of happening. This, you know, the risk B has a pretty good chance of happening, 40%. Now, risk C has even higher probability, but what's the problem with risk C? Risk C is likely going to happen. So why don't we go crazy about risk C?
Because it's immaterial?
Yeah, it's likely immaterial. 5,000. You got these accounts that are $5 million. You got to count the total is 5,000. So even if it does happen, it probably isn't going to be material anyways. Hey, well, I'll tell you in this instance where that's going to come up, and virtually all the audits that I've ever seen external auditors do. Petty cash. Petty cash is when someone has cash they keep in a drawer, and it's for little things like someone needs postage stamps. You know, are you gonna put out a purchase order, have a manager sign it, get for postage stamps? No. You ask somebody to go get postage stamps, they go get postage stamps, they come back and they say, yeah, this is $23.20. Here's the receipt, and then they gave them $23.20 out of this cash drawer. They take the receipts, and all the cash and the receipts should add up to whatever was originally put in that cash box, that petty cash box. Does it always work out that way? No. Where's the receipt? They didn't give me one. You got to get a receipt. Yeah, you get those kind of weird things. But again, it's petty cash. So by definition, it's not material. And external auditors, I don't think I've ever seen them ever audit petty cash because it's never going to be material. So that's one of those things that even though, is there potential for risk for loss? Yeah, it's probably higher than most things. But again, it's such a small amount that you're probably not going to worry too much about it. Okay. Quantitative considerations for materiality. This is one of the really difficult things to kind of come to grips with. Quantitative are dollar amounts. For example, $300,000. So this is quantitative. You say, okay, how do you came up with it? $300,000 is material. And this is kind of how we usually think about materiality. What's it off by? How many dollars is it off by? Are the financial statements materially misstated? So quantitative are the dollar amounts. Now, there are things that are qualitative, and this is more difficult to, well, it's more difficult to audit for one thing, but it's also more difficult sometimes to visualize, and that is, it matters what it is. So it matters what it is as to whether it's material or not. So these are some of the things that will cause something to become material, even if the dollar amounts don't necessarily support it. So this considers the nature of the misstatement. Okay, so example. $10,000 contract violation. So even though it isn't maybe the 300,000 that we came up quantitatively. But if there's a $10,000 contract violation, that might make it material. So qualitative means we actually have to look at it and say what is it? You know, what's the nature of this item that we're looking at? Reverses a trend. So for instance, sales growth every year. You know, maybe a company had sales growth every year that they've been in business, their sales have grown. Well, they come to a certain year and their sales don't grow, but they fudge the numbers a little bit enough to make it look like they've grown every year. Okay, that reverses a trend, because a company that is sales growing versus a company that has sales shrinking can be looked at very differently in the market. Change a loss into a gain. So if they fudge the numbers a little bit to make it look like they're profitable or unprofitable, that could be material, not because of the amount, but because of the nature of it. Big one, management fraud. I'll say this one, these two kind of go together sometimes. Management fraud or increased management's compensation. If you have a problem with management that deals with integrity, that's huge. And the AICPA will tell you over and over and over again that the most important thing is the integrity of management. If you can't trust management, if you think about it, if you can't trust management, you really shouldn't be doing the audit at all. Because you have professional skepticism that you go through an audit, but if you really can't trust management, if they're doing things and hiding them, concealing them, committing fraud, doing things to increase their own compensation rather than putting out accurate financial statements, at some point, if you can't trust them, it becomes a big problem. It becomes material. So, you can have these, even if it isn't dollar-wise material, you can't have it be material because of management fraud. Look at some. Did we do the Anthony case in here? We did. We did. Yeah, that Anthony case is kind of an example of that. They cooked the books and they all got so yeah, so they cooked the books and part of it was to increase their compensation. This last one's a little bit wonky. It's a misstatement due to fact rather than an estimate. And that kind of goes into our sampling thing a little bit. I'll talk about it. So a misstatement due to fact. A misstatement due to fact is not a projection. Remember when we did the sampling, we'd say, okay, it's off by this amount. We projected over the entire population, say, okay, projected value is what? Projected value is 5,200,000, whatever it came out to be. We would take a sample of smaller items and then project it over. Now, if we say that this thing is misstated by 800,000, that's a projection. Now, notice that would be different than an actual $800,000, say, misstatement in a contract. Let's say one contract had a misstatement of 800,000. That's different than a projection. That is a solid $800,000 contract that is misstated. So even if 800,000 is not necessarily material for a projection, it might be material for a factual misstatement. If the factual misstatements get big enough, they themselves might be material for qualitative reasons. And that this is not a projection. This is not in a bell-shaped curve that we think of, this is actually what it's off by. And so that might make it material. So the type of misstatement, whether it's an estimate or a fact, is important. All right. Let's stop here. Let me see what do I have left. You know what? Let's go ahead and take a break. We'll come back and so let's stop here. We'll go back. I want to finish this. We got to give it something done. Let's say be back at time is it? 7:01. Sorry about that. I was talking to you guys, no one answered. How come? Oh yeah, muted. So what I'm going to do is we're going to finish the materiality part, and then we will, and then I think we'll go finish the sampling overview handout. We should be able to get that one done. I don't think we can get done the chapter 6 one today. So let's go to materiality. And so this is sort of the, you know, the age-old question when you first talk about materiality. Well, what is material? I put a spring thing on this door, so whenever I shove it, it bounces back. I don't know why I did that, but if materiality is what, you know, what's material? How much is it? What's the dollar amount? So that's kind of what we're looking at now. This is quantitative, not qualitative. So this is quantitative, what the dollar amount is. And we have some rules of thumb that we use. They're different for different CPA firms will have their own, but they all kind of do the same thing. So rules of thumb. And you can use any of these, and these are judgment calls. What do you use? Which one do you use? You know, do you use income before taxes? You use total assets, total revenues, total equity. There's all kinds of, you know, there's all kinds of different ones you could use. So what we're going to do is we're going to use one of these. It's going to be this first one here. And we're going to use this on 3 different companies. Okay, so the way these work, you'll notice that this one is 5 to 10%, or 0.05 to 0.10. Now that's kind of a large range, right? 10 is twice as much as 5. So the question is, well, who uses the 10, who uses the 5, and who uses in between here? All right. Well, generally speaking, it's going to be inverse to the client size. So the percentage allowed is inverse to the client size. So small companies will use 10%. Larger companies will use 5%. And I'll tell you why in a minute here. Okay, so company A. Income before income taxes, 150,000. Now, especially compared to these other companies, is this a large or small company? Oh, come on. Anyone? Yep, small. So we're probably going to use a larger percentage. So let's say use a 10%. Oops, hold on a second. So we'll use the larger of the percentages because this is a smaller company. $180,000 times 10% is about 15,000. So they would have an overall materiality of 15,000. So they'll use a larger percentage for the smaller the company. The smaller companies will use a larger percentage. And here's why. You know, the overall materiality is $15,000. Honestly, you're probably not going to get sued for a $15,000 error. The lawsuit would cost more than $15,000. So the risks of a smaller company are much smaller than for a larger, right? So that's why we use the larger percentage, because the numbers are fairly reasonable and small. So the potential risk is going to be, relatively, you could allow for a larger percentage because the dollar amounts are just going to be much smaller. And quite honestly, to a small enough degree that you're probably not going to run into any legal problems because of it. All right, let's go to company C on the other end of the scale. Large company, you will use the smallest percentage for them. Oops. So we'll use the 0.05. Need 2.25. So whatever that comes up to. Well, it's what, 1,500,000? $75 million? You know what? I think I didn't put a comment in. I did this wrong. Okay, so this is 75 million. Now, it's kind of just the opposite of for the smaller company. You don't want to have to go into court and say, by the way, we missed a $75 million error. The dollar amounts are just huge. And yeah, people will sue you for $75 million. It makes it worthwhile. But so when you're talking about a very large company, the dollars just get so big so quickly that even at a small percentage, like 5%, you still end up with this fairly large number, that you have to look for things that are so the 75 million is a pretty large number to miss that kind of an error. So you do run into the same thing with larger companies, that just because the dollar amounts are so big, even multiplying by a small percentage, you come up with a large dollar. So you hold them to a tighter standard. Okay, company in the middle. What percentage should we use? So we got a company, it's not small, it's not gigantic. It's still pretty good size though. It's a $50 million, they have $50 million of income. So let's come up with a percentage between 5 and 10. So anyone want to throw one out? What percentage should we use?
7.
Very good. We use 7. Okay, so 0.07. $500,000 or something? I mean, yeah. Okay, so this would be so companies that are in the middle, we would usually take a middle number for that. And again, it has to do with the size of the company and looking at the dollar amounts. So larger companies, you hold them to a tighter standard than smaller companies, just because the dollars are so different between them. Okay. Twice, I guess we need to have that on the twice. Okay, last thing we'll cover in this handout, then we'll stop. I'm going to jump ahead and really stop right here. But I'm going to do this last one. This one won't take more than a couple seconds. Overall materiality. A lot of times what you'll do is you'll break up the materiality between the different accounts. So for instance, let's say you have an overall materiality of 200,000. You might break that up between, say, cash, accounts receivable, and inventory. And these could be, you know, whatever numbers you come up with. And cash, usually you hold it to a tighter one. Sometimes you put cash in at 0 as far as materiality. But just to be, just kind of show you what I mean here. Let's say this is 10,000. So that 200,000 materiality, let's give, I'm just making these up, by the way. 10,000 to cash. Let's say accounts receivable is 60,000. And so how much would be for inventory? So how much of that, oh, the overall materiality, if we're going to split it up between these 3 accounts. So how much would go to inventory? Oh, come on, you guys are toying with me. You know this.
130.
Yep. Right. Yeah, so it's just splitting it up among the you know, different accounts. And by the way, there, you know, like I say, it is sometimes depending on the company, cash you might put in, you can put it at 0 and put this at 70 or whatever. As long as it adds up to the, you know, the total amount. Now, here's the wacky thing, and I'm not sure exactly why they call it this. I think it's because when you're performing the audit, this is what you're going to look at. But they call it this performance materiality. Oops. So performance materiality is giving it to each individual account. So in this case, if I had it like this, well, let me go back to what it was. So if you're going through cash account, if you came across a statement of $10,000, that's material. Accounts receivable, if you had a problem of 60,000, that's material for accounts receivable, inventory, and so on. So you get an idea. So if you're given one of these accounts to look at, you'll know exactly what amount you're looking for that is material. So overall materiality, and that's the total amount. And then the performance materiality is per account. So this is per account. Per is maybe a bad word for whatever. By account, by account. It's better to say per account. It's not like they're all the same. Okay. Now we will stop here. And so again, I got to back up the due date on this again. We're never going to finish this thing. All right, well, we'll finish it next week. Promise. You guys don't believe me, though I don't believe you. Okay. So we're going to talk a little bit about the allowance for sampling risk. And this is just the bell curve kind of stuff that you guys have seen in your, well, I think any statistics class you ever took, you probably saw the bell curve. And it's how sure do you want to be about your results. And so, for instance, if there's a standard deviation of $5,000, that means it could go either way by $5,000. And so you have this, you know, spread. For instance, if the standard deviation was if the projected value is 100,000, standard deviation is 5,000. If you were 63% sure, that means it would be between 95,000 and 105,000. If you were 95% sure, we'd take in 2 of those. And if you're 99% sure, you know, it'll be all three of those. Now notice that if you're 99% sure, I think I got it down here actually. Yeah, that's okay. So this will be the green, it'll be like the green one here. So you're 95% sure that this is between, so plus minus 10,000, so 100,000 minus 10, so 90,000. So you're 95% sure of that it's between those two. Now, if you want to be more sure, it's actually going to be a larger spread. So you're 99% sure that it's between 85,000 and 15,000. So the more sure you are, given the same sample size, the larger the allowance for sampling risk. So the allowance for sampling risk is going to be larger with the lower sampling risk, given the same sample size. Now, you can take a larger sample, and that will narrow it up. It's sort of like, I'll do it with my hands. It's sort of like this. If you have a sample of like 100 items, your bell curve will look like this. And then if you take a bigger, sample, you get more sure. It kind of collapses in, right? So as you get more and more of a sample, until you get 100%, then you're 100% sure wherever it is. If you take 100%, but as you get more and more items in, it narrows up that bell curve. Okay. So test of controls, and test of controls are actually tested as much or more than the dollar amounts for substantive testing, like mean per unit, the classical sampling mean per unit ratio difference, monetary unit sampling, the ones that we spent a lot of time covering, those first two handouts. Testing for controls, you don't test the dollar amounts, you're just testing the controls themselves. And they're yes, no. Is the control working or is it not working? So that's kind of what we're looking at here. And actually the CPA exam has tested this at least as much as the dollar amounts, maybe even a little more. Okay, so these are yes, no tests. Either the attribute is there or it's not. So this is attribute sampling. Kind of like flipping a coin. It's either heads or it's tails. It's one or the other. Okay, so for example, a client may have a control that requires 2 managers' signatures on checks written for more than 5,000. So if the check is more than $5,000, it has to have 2 managers' signatures. So the auditor would take a sample of checks written for more than $5,000 to determine that they had 2 managers' signatures. By the way, why would they have 2 managers' signatures?
A double check.
Yeah, and especially for checks
protocol.
For checks that are more than $5,000, they have another, bring another person in. One of the things that you find a lot is that once you start bringing more people in, it's less likely bad things happen. If I'm going to steal something, And all of a sudden they bring in somebody else and say, okay, well, this, this other person is going to sign off on this too. Well, I might have second thoughts about it. Maybe that other person doesn't even care, but I don't know that. And, sometimes it's a good idea to have these, again, when someone else comes around, a lot of times even if you were tempted, well, no longer are you tempted. Okay, so each check, a clunky way of writing it, but each check in the sample would be determined to either have two manager signatures. We'd say it was a yes, so they approved it by two signatures, or they didn't have two signatures, they only had one. You know. Okay. The auditor allows for an error rate of 7%. The sample was 200 checks. And allowance for sampling risk is 2. We'll get to that later. Okay, so coming down here. So we had 200 checks. So we look at our checks. $194 had two signatures. So of the 200 checks, 194 had two signatures. Checks with only one signature had 6. So what's the error rate? Of the 200 checks that we picked, 6 of them only had one signature. So what's the error rate going to be? Anyone? What's the error rate? What percentage of the checks were I should say written incorrectly or written not following the procedures? You can put it in chat. You don't want to say it out loud. You can put it in chat with a direct message to me, and I won't read your name.
To be honest, Professor, I'm not understanding your question. Like you're saying, what is the error rate of 200 checks if 194 require 2 signatures and only 6 require 1 signature?
Actually, they all require 2 signatures, but 6 of them did not have it.
Well, wouldn't it be
3%?
that?
Yeah, yep.
Sorry.
Yeah, so these all require, but checks with only 1 signature. These are no, they did not have the 2 required signatures. So these are 200 checks written for more than 500, not 500, 5,000. Yeah, so you take the 6 errors. That is not 6. And if
would it just be the 6 that only requires 1 signature would be the rate? I'm not sure what that percentage is, but wouldn't it be that?
They all require it.
Yes, but you're asking about the errors, like what rate of risk? So wouldn't the risk be the 6 that only require 1 signature? Checks with only 1 signature is 6.
Right. They're supposed to have 2.
Right. So wouldn't those 6 be the ones that are in jeopardy of having errors?
Yeah, those are errors, exactly. Yeah, so 6 errors out of the 200 total. equals 0.03 or 3%. You know, I'm going to kind of clean this up a little bit. Second here. Okay, so these 6 errors. So this is going to be the error rate. Okay, so this is what we found. So this is our best estimate as far as what the error rate is. The error rate is 3%. However, now we come back to this allowance for sampling risk. Kind of like the allowance for sampling risk we had up here in dollars, we're now going to have a sampling risk for, I'm going to copy this. Let's rename this thing here. So this is what this would look like. The error rate is 3%, plus or minus 2%. Get rid of that. Bring it in the middle there. So, in other words, the error rate here would be between 1%. We don't, and actually we don't really care too much about the low rate, to 5%. So this would be what we would use for our green. So the error rate, you know, the upper limit would be the 5%, the lower limit would be 1%, but we're more worried about this 5%. So if we were looking at this and saying, okay, you know, the error rate is 3, but plus or minus 2, in this case, we look at the pluses more than the minuses. This is one we're worried about. So the upper limit on that is 5%. Would we be happy with it? We would allow for an error rate of 7. So we would accept up to a 7%. So are we okay with the 5%? Our sample showed that the upper limit on the errors is going to be 5%. 3% error rate, that's our best estimate. But we have this plus or minus 2%. Yes, good. Yeah, we would accept it. Let me draw some arrows in here. So we would think that this would be between 1% and 5%. We're worried about the upper limit, 5%. The upper limit is less than the allowable. In other words, we would accept it up to 7%, but this is only going up to 5%. So we would say, yeah, this is okay. So would we take it? Yep. we'd say that their controls are working enough that we can rely on them. Make sense? It's the same as this up here that we kind of did with some other problems, especially the Monterey unit sampling. It's kind of the same thing, except that instead of dollars, that you're going to do it in percentages. All right. This is completely separate, but we'll look at it. All right. So internal controls. Auditor's assessment. Let's make those green. And the actual, let's make those, I don't know, I guess yellow. Okay. So once we get our our assessment of the controls, this is a sample. So if you are, let's say you're auditing to the 95% level. 95% level means 5% of the time you're going to be wrong. Just, this is the way it is. That if you audit to the 95% level, 5% of the time you're going to be wrong. 95% of the time you're going to be right, but 5% of the time you're going to be wrong. Your sample is not going to be representative of the population as a whole. And that's just statistics. So at the 95% level, you're going to be wrong 5% of the time. I should say you're wrong. That the sample will not represent the population as a whole. All right. So it could come about a couple different ways. It could come about that you see the controls are working better than they really are, or it could be that you think the controls are working worse than they really are, because your sample does not represent the sample as a whole. So we get the 7% cutoff, and it's possible that you could have an error going either way, that the population as a whole really doesn't, the sample doesn't reflect the population as a whole. All right, now, if the auditors come up with the thing that the controls are adequate, and the actual controls really are adequate. So the auditors think they're adequate. The actual controls, if you took 100% sample, would show that they are adequate. This means you came up with the, that it was correct. This came up with the population, your sample reflected the population as a whole. And same thing for inadequate. If you said, okay, these controls are not working like they should, and they are inadequate, and if the controls are actually inadequate, again, you came up with the correct, the sample reflects the population as a whole. So those two are good. This is kind of what you want, okay? If the controls are bad, if we find it, that's fine. We can do something else now. We'll do more substantive testing or whatever we need to do. Or if the controls are adequate, like we have here. We came up to the controls are adequate. Well, if they really are adequate, that's good. Our sample represented the sample as a whole. Okay, now the 5% could fall into one of these two categories. It could be that it's inadequate. For the auditors, they come up they're inadequate, but it happens that they just picked a bad sample. It could be they picked a bad sample that said, okay, these controls are not working, when actually they were. All right. So if you came up with the controls are bad, you say, okay, well, we'll have to do more testing in this area. So you do a lot more testing in that area. And eventually you're going to come out that, you know, there's basically sampling for dollars that, okay, everything's fine. You know, that, yeah, the controls, we tested those controls and they said they were bad, but when we did the actual audit, everything was fine. So you're going to do a lot more extra testing than you normally would if you thought the controls were adequate, which they really were. So this is going to lead to an inefficient audit. You know, you took more than you needed to, but that, hey, that's, you know, that's the way it goes if you're taking a sample. Now, you could also do it the other way, though. You think the controls are adequate, but really they're inadequate. This will lead to an ineffective audit. One too many N's in ineffective. Oh, they're not enough. There we go. Okay, so let's call this, we'll call this problem A. We'll call this problem B. And let's play, which scenario is worse? A or B? As an auditor. So this one is inefficient. You have to do a whole bunch of extra work. This one's ineffective because you think everything is okay when it's not. And you do your audit thinking everything's okay. So which one of these is worse for the auditor? Scenario A or scenario B? I'm going to put in a couple other things here. This is something that's called incorrect. Go ahead.
Would it be B?
Yep, B is a problem one. This is called incorrect acceptance. So, ooh, I lost my little voting thing. Yeah, B is going to be the problem here. This is the one that is ineffective. Do you think everything is okay when it's not? This means a material misstatement could show up on the financial statements. Because you think the controls are working fine, you know, maybe you can cut back on your substantive testing, when actually just the opposite. So a lot of times when you see, like in the standards, they'll talk about incorrect acceptance a lot. You wonder, well, how come they don't talk about incorrect rejection? It should not be the same. You know, what if they talk about incorrect rejection? Incorrect rejection is just, you know, you do a little extra work, you know, or a little, maybe a lot extra work, but whatever. But the audit comes out, you know, effectively. This is really the problem here, this incorrect acceptance. And you think everything is fine, but it's not. Okay, we have the same situation for substantive testing. In fact, it's all the same. I'm going to copy this because the idea is the same. We have to do with materiality instead of controls, but Okay, I think the idea is the same. What color did I make those? Is it yellow? No, green and yellow. Okay. So these are the auditors, and this is the actual. And again, you know, if you think they're not materially misstated when they actually are, it's an ineffective audit, or it's incorrect acceptance of their financial statements. And down here, it's inefficient. Usually what happens is you'll do more testing. And at some point, if you get a large enough sample, you're going to realize that these are not misstated. So this will be an inefficient audit because usually you do extra audit procedures and, you know, but the same idea, ineffective audit is the one that is the dangerous one. And is it, you know, this is up here, you're talking about percentages. Up down here, you're talking about the dollar amounts. Okay, now there is a relationship between test of controls and substantive testing. And generally, if you can't rely on the controls, you do more substantive testing. So test of controls, these are the tests that are done to rely on the controls. And this is testing the dollar amounts. Okay, so here's the scenario. Suppose the initial test of controls indicate the controls cannot be relied upon. So you start testing the internal controls, and you find that you cannot rely on them. So what do? Do you increase the test of controls or increase the substantive procedures, the dollar amount testing?
Can you repeat the question, please?
Yeah. So you're doing your initial test on controls. So let's say you start doing the test, you know, for example, let's say that you did the test up here for the two manager signatures. And suppose you pick out 10 of them, and none of them have any, none of them have two signatures on it. You can't rely on it. So what do? You have these really bad controls. Are you going to increase the test of controls, or are you going to increase the substantive test, the dollar amounts?
The dollar amounts?
Yep, exactly. Yeah, if you can't, your whole point of relying on the controls is that you can reduce these substantive procedures. So if you find out right away that you cannot rely on them, at that point, you know, more testing isn't going to make these controls any better. You ditch the testing of controls and you simply increase the dollar amounts. So if you can't rely on the controls, you know, which you kind of want to, then you got to go to, you know, plan B or C or whatever plan this is, and do the warrant of substantive procedure. Now, the relationship between test of controls and substantive procedures is inverse. The more of one you do, the less of the other you do. So if you test the controls and the controls are really good, okay, you're going to test the controls, and then you're going to back off on the substantive testing because you can rely on the controls. If you can't rely on the controls, you say, okay, forget these. There's no use going on with these. We'll stop doing these, and we'll just do much more of these. So it's inverse. Now, the auditor doesn't usually choose that. Usually it's the controls themselves. If they can rely on the controls like they want to, they'll keep testing the controls. But if they can't, then they go on to substantive procedures. Hey, we finished a handout. We have something to turn in. Okay. Any questions on that? And you know, this handout, this last one, I know it kind of seems like it's a little jumping all over the place, but actually the stuff that's in here is it's tested quite a bit on these. And when I was doing the CPA review, when I was teaching it, you know, this is one of those things that really jumped out was that there was like a whole bunch of little things that got tested quite a bit. And you know, so this one, it kind of jumps around. This started out as just a list of, oh, by the way, here's something else wacky you should know before going into the CPA exam. And then it kind of turned into a whole handout of its own. But any questions on that?
I do not. Thank you.
Okay. Well, let's call it a night. Look at that. 11 minutes early. All right. And we'll pick up the other handout next week. All right. Have a good evening, guys, and I'll see you in a week's time. And nothing due, I don't think. Let me check and make sure I'm not lying.
Thank you.
Thank you, Professor.
Thanks, guys. Good night.